I want to tell you what compound interest is, how you can use it in your advantage in order to reach financial independence, and why right now is the best time to start your financial independence journey. Simply put, compound interest is the interest you earn on interest. When the interest you earn on a balance in a savings or investing account is reinvested, it's earning you even more interest. As Benjamin Franklin said, money makes money, and the money that money makes money. Compound interest accelerates the growth of your savings and investments over time. But it can also be a recipe for disaster if you're having trouble paying your debts. Keep on watching to find out how you can use in your advantage what Albert Einstein allegedly called the eighth wonder of the world. When it comes to compound interest, you're not just earning interest on your principal balance. Even the interest you earn is making you more money as it accumulates and is added back into your principal balance, which earns even more money for you. The frequency at which interest can be compounded is a big determining factor in how quickly your investment builds up. Your returns could range from very low to high depending on the rate you choose. The more frequent the compounding, the bigger the return on your investment. Although very important, the frequency is only one factor. When calculating compound interest, there are 5 key factors to take into account. Each impacts the final amount, and by making slight adjustments, you can maximize your returns. Here they are. Interest. Interest rates are the rate you earn or pay back. The higher the interest rate, the more money you earn or owe. Starting principal. Obviously, the size of the initial deposit also has a big impact on your final balance. The more you start with, the quicker things will increase your savings account. Frequency of compounding. Compounding interest is the process by which interest is calculated, then added to the original sum of money, and that calculation is repeated. In order to make the most of your money, it's important to clarify how often the compounding takes place. Is it annually, monthly, daily? Duration. How long do you intend to keep money in a savings account or hold on to a debt? The longer you wait, the more you'll be able to earn or owe. Deposits and withdrawals. To make the most of your savings plan, you should consider how frequently you expect to deposit money into it. Part of what will help determine your future loan payments is the pace at which you deduct payments. For example, whether you put a lot down at once or gradually pay down your debt over a longer duration will affect the total interest paid on your loan. Coming up next, I'm going to tell you why right now is the best time to start your journey towards reaching financial independence. So stay tuned for that, but first like this video, and comment down below what other questions do you have about compound interest, and maybe we'll answer your question in the next video. A wise man once said, "Someone is sitting in the shade today because someone planted a tree a long time ago." If you begin by investing early in your working life, you will be able to have the necessary funds to achieve financial independence when you no longer enjoy the benefits of a salary. The fact of the matter is that the earlier you begin your financial planning journey, the better it is for your future, especially if you fancy a big house, an extravagant car, and a flashy lifestyle. It is a proven fact that even the smallest investment can have a telling impact on your financial status. Therefore, by prioritizing wealth management and by staying invested, you will have put in the foundations that you need to meet your long-term financial goals. Although saving or investing may not be your top priority in your 20s, it will ultimately allow you to live the life you dream of. As all good habits are to be learned early in life, making savings a habit as a youngster could go a long way in shaping your financial future. To summarize, taking advantage of the power of compounding is the single most important reason for you to start investing right now. Keep in mind that every day your money stays invested is a day that your money is working for you. And, the longer the savings period, the more time one gives to the interest income to grow, which, in turn, will help create a large enough stack to meet your financial goals and contribute towards a positive financial well-being. Although compound interest favors those that start early, even if you haven't started investing yet, all is not lost. All you've got to do is simply make up for your shortfall in years by increasing the amount you save. However, if you are still young, don't make the mistake of waiting to play catch-up. You never know what life is going to throw at you in the future, so be prepared by saving early to ensure you have a secure fallback option in times of need. Let compound interest do the work for you. Now, if you want to learn more about how you can profit during a recession, or how you can grow your wealth in general, make sure you check out these 2 videos right here. I'll see you in the next video.